and welcome to the latest Insider interview. Our guest today is Paul Niven, manager of the F&C Investment Trust. Paul, thank you very much for coming into the studio.
Nice to see you.
F&C is often seen as a one-stop shop for global equities, but can you explain your approach to stock picking and how you build this portfolio for customers?
Sure. So my role is not as a stock picker. My role is essentially to structure the overall portfolio in a manner that's consistent with our performance objectives. And the way that I do that is by selecting from strategies within Columbia Threadneedle Investments, the manager of the trust, and actually from managers from across the market. We invest in listed equity and private equity. And within the listed equity component, we invest into different global strategies and different regional strategies. And so, for example, we have in the US a value manager, or two value managers actually, one component run by Columbia Threadneedle Investments, one a Dallas-based manager called Barrow Hanley, who focus on value investing. We also have the US large cap growth portfolio managed by JP Morgan out of New York. So blending together those different strategies with different styles enables us to diversify exposure, adding returns, reducing risk, providing hopefully a smoother performance outcome for shareholders. We take a similar approach in private equity, where we have private equity resource and expertise within Columbia Threadneedle Investments. We use them to source and select fund investments, but also individual co-investments, which are individual company investments, albeit in the private market. And we supplement that with third-party exposure through various areas, but notably with Pantheon running a bespoke program where they source and select leading growth and venture managers for us as part of the portfolio.
And what do you look for when partnering with a third-party fund manager? Are there any special questions you ask, or red flags or green flags that actually might help listeners at home pick their own funds?
Sure. So I think the general approach is there's more than one way to win in terms of delivering returns in equities. What do I mean by that? Essentially, through the market cycle, you will see different characteristics of stocks performing at different times. So, for example, more lowly valued value stocks, cheap stocks will perform perhaps better in a rising interest rate environment when inflation is also rising. Growth stocks, which have got high momentum, may well perform in a declining interest rate environment. High quality companies, which have got strong moats and dominant market positions, do tend to outperform in the long run. So value, momentum, quality, putting aside size, they're all characteristics which in the long run can prove to be winning strategies for investors. And you see many asset management organizations that brand themselves or position themselves around one of those aspects or one of those ways of investing. They could be a quality investor, a growth or momentum investor, or a value investor. And they'll look for companies that have got attributes which align to their philosophical beliefs. So we've got strategies internally which align to those types of characteristics, albeit Columbia Threadneedle typically is more of a quality growth house in terms of the way that we invest. And externally, clearly we can source and select from across the market. And specifically on your question, we look for managers that have got a clearly articulated, repeatable, robust investment process where we have confidence in terms of not only understanding why and how returns have been delivered, but there is a persistency and consistency that should give rise to a positive outcome in the future as well.
And this leads you to nearly 450 companies. That sounds like a lot. So is that too many for a global equity portfolio?
So that 450 does include our private market exposure as well. If you just take the listed market exposure, then the number is less than 400, and actually that number is coming down. I think there's a balance to be struck between concentration and diversification, and there is no right number in terms of what the right number of stocks is. The way that we approach investment, however, is by giving managers a mandate to pick a relatively concentrated number of stocks which align to their way of investing. So to my earlier example, our value manager will be picking 40 stocks roughly in the US value space. Our European manager will be picking 30 or 40 stocks in the European space. Our emerging market manager are in 40 stocks. When you add that together, you do get to several hundred stocks in the portfolio. The principle being that each of those individual strategies is designed to deliver a specific outcome against a specific yardstick, whether it's a geographic yardstick like the emerging market index, or a stylistic benchmark like a growth benchmark or a value benchmark. And when you blend them together, again, you can add returns and reduce risk by diversifying across those different sources of return. But it's a balance, I think it's fair to say, in terms of having sufficient number of strategies and stocks to diversify while remaining sufficiently different than the index to essentially justify our position as an actively managed fund.
You have about 9% in the UK. That's more than double the global equity index. So why is that? And can you give some examples of UK shares that you like?
Well, that 9%, again, does include the private market exposure. If you strip out private markets and just look at the global equity component and how much is in the UK, I think around 3.5%, 3.6% of global equity benchmark is UK. We're a bit above that. We're 5.5% in the UK. So we're a bit above, but not quite 9%. I actually don't have a strong view that the UK is a great place to invest, unfortunately, right now from an equity perspective. I do believe that the market looks cheap optically on any kind of historic metric, and certainly that is the view of many of the managers that we employ to select stocks on the trust. And the reason we have that slight overweight position to UK equities really is a function of the underlying stock pickers rather than me making a big top-down call. I think for the UK market specifically, commodity prices are very important in terms of the performance outcome, and also the level of sterling is quite important in terms of the UK market outcome, given the proportion of earnings which are actually derived from overseas, in terms of UK companies deriving earnings from non-UK sources. And on balance, I think there's a case to be made that maybe sterling rises a little bit further from current levels. Commodity prices, despite all the concerns related to the Middle East, are relatively soft, with notable exception of gold. But if one looks at oil, oil's relatively soft. So I think those two aspects are a bit of a headwind for UK equities. I think UK equity market has been clearly an area that has been looked cheap for a long time, but is unfortunately disappointed in terms of the earnings growth outlook and delivery of earnings from that area. But our managers see some good opportunities. For example, NatWest is a company that our pan-European equity manager holds. They view that as very attractively valued, high return on equity. Maybe the lower interest rate cycle is going to help profits there. We've just bought, or that manager's just bought Taylor Wimpey in the UK as well. Well-known house builder, very strong land bank. We may have some reforms coming through that might push through more by way of house building in the UK. So there's some examples like that, plus Compass Group as well, which has consolidated its position as a leading provider of catering, outsourced catering solutions post-pandemic. So there's some numerous stock-specific examples. Top down, the UK, unfortunately, I still find relatively unexciting compared to some of the prospects we see elsewhere.
Private equity is one of the areas that really does distinguish you from the index. So how much is invested in private assets, and why do you like them so much?
So we have around about 10% of the overall asset exposure in private equity right now. And as a closed-ended fund, we're not dealing with inflows and outflows. So we have, notwithstanding buybacks, permanent capital, and we can take a long-term view. And that's advantageous in terms of the investment perspective that we can take. And that is one reason why we do choose to allocate capital to private equity, We've got a very long experience of investing in private markets. Our experience in general terms has been good. What I mean by what I mean is that we have delivered typically an excess return on that private over public exposure. Last few years have been more challenging clearly for private equity returns. We see opportunities in the private market space with small, very fast growing companies that we don't necessarily find in the public space, so it offers something slightly different. And there are numerous examples of strong performance outturns that we've enjoyed from private market exposures. Earlier this year, we realised an exposure in Jollyes, which is a pet supply retailer, which many people will be familiar with. We made a 3.7 times return on that investment since we committed in 2018. So there's some very good opportunities, we think, still in the private market space, albeit fair to say that valuations have been relatively stagnant in the last couple of years. That's been a little bit of a drag to our returns, but longer term, we think there remain good opportunities. And that programme that we have with Pantheon, again, we're in very early with leading growth and venture managers where there is a relative persistence of return. And we expect in a multi-year view that will again be accretive to our returns for shareholders.
The trust trades on a 9% discount. So why is that? Is that linked to the private assets and scepticism over the valuations and therefore the net asset value of your portfolio?
It's a really good question, and again, a very difficult question to answer precisely why we are trading at a roughly 9% discount as we speak today. If we reflect back in Q1 2023, we were actually trading at a premium, albeit briefly. So it wasn't that long ago we were trading at a premium at a time when I think, again, private equity sector was at a relatively wide discount. So I think one can make an argument that perhaps some scepticism with respect to unlisted valuations could be part of the reason for the discount. We have seen a general widening in discounts across the whole investment trust sector, unfortunately. It might be that people are somewhat concerned about potential tax changes and want to crystallise gains that is leading to some net selling. We know the cost disclosure issues not affecting us directly, I don't think, but have had a broader impact in terms of the sector. But the reality is we are trading wider than where we would like to be, and certainly wider than we have been in recent years. And my view is that given the performance that we've delivered, that discount does look somewhat anomalous.
And are there any policies in place to actually try and narrow that discount?
There are. So we have consistently used and applied buybacks, essentially to take excess supply out of the market. And to give you a sense about the scale of buybacks that we've undertaken, last year in 2023, we bought back 8.6 million shares. This year, as we speak, we've bought back in excess of 21 million shares. So we're obviously just past the third quarter, but we've bought back more than twice as many shares as we did in the whole of 2023. So the level of buybacks has stepped up, and we're currently trading around £10.50. So that's more than £200 million that's been used to buy back shares, which is relatively substantial for us as a £5.1 billion listed company. So that deals with the supply side of things. That is, I think, helpful in terms of managing the supply demand imbalance, which leads to the discount. On the demand side of things, we are certainly actively marketing the trust. We do believe that investment proposition is strong. We do think we're very well placed to meet the needs of retail investors, and therefore there is a very active marketing programme that we hope to create incremental demand from.
And finally, the question we ask all of our guests: do you personally invest in your trust?
I do invest in F&C Investment Trust. I believe in the investment proposition that we offer for retail shareholders. And I think it's important for managers to commit their own capital to the investment trust that they manage.
Thanks very much for coming into the studio.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment and subscribe. See you next time.